Hi, I'm Lauren Taylor, Managing Director of Active Property Group. Today I wanted to speak to you about the various factors that impact the return of our pooled mortgage fund, including the cash rate set by the Reserve Bank of Australia. Hopefully this will give you an indication of why returns fluctuate from quarter to quarter. When you invest in our pooled mortgage fund, your funds are lent out to a portfolio of borrowers, and the returns to the investors are based on the interest rate charged to the borrowers within the portfolio during the quarter. What's important to note here is that each borrower within the portfolio is being charged a different interest rate, so the returns will fluctuate. And one thing you may not know is that all borrowers actually pay their interest up front rather than having to make monthly repayments like a regular bank loan. There are a few different factors that affect the interest rate charged to borrowers. First off, the interest rate paid by the borrower will vary based on whether they have taken out a first mortgage or a second mortgage. Because first mortgages carry less risk, they have lower interest rates. On the other hand, second mortgages are higher risk and therefore will have higher interest. At APG, our loan portfolio is a combination of both first and second mortgages. We target having around 70% registered first mortgages and up to 25% second mortgages. We do so in order to maximise potential returns while still protecting investors' capital. And we keep 5% as available cash as a buffer to cover for distributions and redemptions and to ensure funds are available for any urgent loan applications. The second reason the interest rate paid by the borrower will change is the loan purpose. While all of the loans we settle have a genuine business purpose, there may be different reasons that a borrower may require funds. If the purpose of the loan is deemed to be riskier, then a higher interest rate would be charged. For example, a development or construction loan can be riskier as they rely on things like approval of development applications or the accuracy of construction costings. Because the purpose of the loan has more risk associated, the interest rate charged to the borrower will usually be higher. Another reason the interest rate may vary is the security property used to secure the loan. All of our loans are secured by Australian real estate, however, some security property types are deemed riskier than others. This is because if a borrower went into default and we needed to sell the security property in order to recover the costs of the loan, then it would be easier to sell a property such as a residential house rather than a vacant block of land. As such, higher interest rates would be charged to a borrower using a security property that is riskier, like a vacant block of land. Lastly, if a borrower extends their loan or goes into default, then they are liable to pay higher interest on their loan. For every loan we settle, we offer borrowers some extension options which allow them to extend the loan if needed. However, in order to do so, they need to pay a higher interest rate upfront. If the borrower goes into default and hasn't repaid the loan, then they are required to pay higher interest until the loan is repaid. While having a borrower in default on a loan is not ideal, it can have a positive impact on the interest rate earned once the higher interest rate has been paid or the security property is liquidated and the higher interest is recovered. Finally, let's quickly chat about the impact the RBA cash rate decisions have on returns. When the RBA increases or decreases the cash rate, we will also pass on that increase or decrease to any new borrowers as we need to remain competitive in the market. However, as all of our borrowers are on a fixed interest rate throughout the prepaid term of their loan, the interest rate will not change for any existing borrower unless they extend the loan beyond the original loan term. This means that an increase or decrease to the cash rate will have a gradual effect on the overall return of the portfolio, not an instant impact. As more of the borrowers repay their loans at the old rate and those funds are lent out at the new rate, the returns will slowly decrease or increase. I hope this has been helpful, and if you have any questions about investing, then please get in touch at investorrelations@activepropertygroup.com.au. Thanks, and see you next time.